Welcome to Author's Note. This has been a big week for Turkey. The good news is that Fitch, one of the 3 international credit rating agencies that investors follow, has upgraded the country to investment grade. Here with me to discuss the implications is Timothy Ash of Standard Bank. Timothy, if we look at this chart, we see how Fitch's ratings compare with those of Standard & Poor's and Moody, and with other countries. Could you please tell us what the implications of the upgrade are?
Well, I would argue, and I've long argued, that Turkey has been long deserving of investment grade rating, given its performance through the global financial crisis. I would argue perhaps 2 years ago. That said, I think investors definitely watch ratings, both direct investors and portfolio investors. Portfolio investors typically need 2 ratings, 2 of the main rating agencies, they need them on investment grade. And I think when we get that, we'll see a big wall of money into Turkey. Lots of portfolio inflows, portfolio investors feel much more comfortable with a broad story in Turkey. And the second point is that foreign direct investors, these guys again view ratings as a general bill of health of an economy. And investment grade, I think, gives that bill of health, and it would also see a lot of foreign direct investment inflows. And that's really important for the real growth of an economy, real growth and development.
And when do you think we might see a move from either Moody's or Standard & Poor's?
Well, Moody's, they have an investor conference later this month. I mean, both Moody's and S&P have been pretty downbeat for a long time on Turkey. I mean, they focus on the external financing risks in particular, large current account deficit, large external financing requirement. These are the things that really concern them. I would argue, though, that it's a sovereign rating. It's the sovereign creditworthiness. And the key point with Turkey is its public sector debt GDP ratio is only 40%, half the EU average. And of that, only 1/4 is external debt. So in a worst case scenario where the current account is not financeable, the exchange rate adjusts. But I think it's unimaginable to think of where an exchange rate would need to go, that the sovereign would not be able to meet that very low level of external debt leverage.
If we now move on to the next chart, we see how Turkey's sovereign CDS spreads have narrowed in recent months. Do you think there is further to go in the light of the credit ratings or changes, or do you think that investors have in fact anticipated what Fitch has now done?
Well, I think this chart says to me that the rating agencies have been behind the curve for an awful long time. I mean, the market has priced Turkey like investment grade. South Africa and Russia are both investment grade for the past 2 years. And I think that reflects the fact that, through the global financial crisis, Turkey had a good crisis. It rebounded relatively quickly. Growth resumed a pretty stellar rate. And policy's been pretty prudent, both fiscal, banking sector's clean, all that kind of stuff. So basically this ratio, it's very tight on both South Africa and Russia. Probably we'll see a little bit more momentum, and we've seen quite a lot of momentum over the past week or so on the back of the rating upgrade. I think probably more interesting is local markets, and there the two investment grade ratings are really key. If we get those, I think we'll see portfolio inflows into local debt markets. That should rally much more significantly, although it has rallied a lot already, as I mentioned, over the past week.
And let's now see what the currency's been doing. Here we see that the Lira has weakened over a longer perspective, although more recently it's been quite stable. What do you think is the outlook for the currency in the light of the possible increases in investment flows?
Well, the currency weakened late last year and into the early part of this year because of concerns about overheating. Wide current account deficit, that was the main problem. Actually, what we've seen in the last 6 months is rebalancing. Slowing of domestic demand, slightly better export performance, probably related to the currency adjustment. So I think in general people feel much more comfortable with where Turkey is now. It's not running a 10% current account deficit anymore, it's about 7%. I think people feel that's much more financeable. What's interesting with the ratings upgrade, it creates a new challenge for the central bank. As I mentioned, it will see a lot more money pumping in to local markets. Rather than depreciation pressure, you'll see appreciation pressure, and that leaves a question mark for the central bank in terms of how it manages that. And I think initially what we'll see is a direct intervention to rebuild FX reserves. Turkey has relatively low FX reserve coverage. And beyond that, well, let's see how big the inflows are. I mean, possibly at a later stage, maybe a loosening of monetary policy in terms of lower interest rates.
Timothy Ash, thank you very much. So there you have it, a reasonably optimistic view of Turkey's prospects. But it is a good week to be optimistic in, given Fitch's decision.